Hello, Mark Ostalt from ADM Investor Services International with some thoughts this week on how markets are behaving. We've seen a little bit of erratic behavior appearing in some of the stock indices, and it's all against the backdrop of relatively calm treasury yields. So my first chart this week is the 5 and 10-year nominal US yields. And as one can see, actually, we've been trading in a very narrow range for quite some time. There's none of the pressure that was there back in January and February. So one might assume that the stability in US long-term yields would actually underpin markets. And I think to a certain extent that's true. Nevertheless, if we look at my next chart, which is US 5 and 10-year tips break-even inflation rates, we can see that the recent rise or the renewed rise in a lot of commodity prices, above all, most recently, the rise in oil prices, which I think still is very much key for pushing up sentiment elsewhere. There is an upward creep there. And so the inflation trade, despite the Fed's best efforts to persuade everybody that we can look through all of this, is still very much in people's minds. Now, if we then move on to how this has played out in terms of that stability for US 5 and 10-year yields, we can see when we look at the third chart, which is the VIX volatility index, that really it's helped to drive that down very, very sharply. Of late, the volatility that we're seeing in pretty much all the US major stock indices is clearly contributing to a little bit of an uptick, but we're still only at 22 on the VIX, and that is actually low by any recent standards since the start of the pandemic. How is all the inflation trade playing out? Well, I think one interesting chart is to have a look at is global container rates. This is shipping rates. This is my fourth chart. This is shipping rates for containers from China, both to the US and to Europe. And as one can see on that chart, at various stages, the reopening of economies has created a further spike. And as much as capacity is coming back online, we're still finding a lot of things in the wrong sort of places, which is driving that. At some point, this will start to normalize as the recovery normalizes. However, what we know from last week's labor data, just rolling out vaccinations and rolling back activity restrictions isn't necessarily going to be the driver on all of that. There is a lot more that needs to fall into place. In fact, everything needs to get back to normal so that everyone can go back to work, because some people simply can't go back to work because there aren't the school facilities or the childcare facilities. And so that's creating problems and all these bottlenecks, which we can see above all there. Fifth chart today is a familiar one now. In recent weeks, the Goldman Sachs commodity price indices, as one could see, we are still driving higher on all of those, and they're going to levels which we haven't seen in quite some time. However, that's not the whole story here. I think the other thing that one needs to have a look at is how we're getting all this volatility in the major stock indices. And I think particularly the comparison between the S&P 500 and the NASDAQ is of interest. S&P 500 tailing off a little bit, NASDAQ 100 taking far more of a substantial slip because of doubts about the tech sector. And I think in terms of the inflation trade, the very simple point is if people expect the inflation rates to be driven back down after these temporary blips, then we'll need to see lots of technology being available to drive those prices back down. Clearly, there doesn't seem to be that much faith in that, because my seventh chart today, and the last one, is the Taiwan Stock Exchange Index, which has broken down through a key support line and above all driven by semiconductor producers, which to me suggests that there is some doubt in the market about whether that will happen. And those are the thoughts for this week.